Hey everyone, Tom here. Welcome back. Welcome to summer. And I want to talk about U.S. holidays. I want to talk about the impacts they have on the markets. And I want to share a trade with you that I like when I did my own research on these holidays and did something called holiday stacking. There are 10 holidays in the U.S. market where the markets are closed each and every year. During the summer, there's actually 4 of them. So count them off with me. We have Memorial Day. Yeah, and we might argue that's not a summertime trade, but that's the unofficial start to summer. You have Juneteenth, July 4th, Labor Day. Of those 4, 3 have patterns. All right. And the reason I say 3 have patterns is because Juneteenth hasn't been around long enough for me to have any meaningful data to see if I can spot a pattern. So what I want to do is I want to look at all of this data and I want to see if indeed we can find something from what's called theory to reality. The theory is what everybody else thinks about the market. The reality is what I've found and how I'm trading this summer. So here's theory. The traditional traders plan. They're going to take something like SPY. They're going to buy it a few days before the holiday. They're going to sell it the day before the holiday because that's what they've heard have worked. And you know what? It has worked decades ago. The last 10 years, not so much. Take a look at the chart on the screen. You'll see what I'm talking about here. I've got U.S. market holidays just last year. Memorial Day was a wash. Between the beginning and right up to Memorial Day, it's basically break even. Yes, July 4th worked because we blew out of the gate, but then we gave it all back in Labor Day. So 2024 is definitely an example of a mixed results year. What I did was I took the data to look in between the holidays. So between Memorial Day and July 4th, I found a 70% win rate on SPY going back 10 years. 7 of the last 10 years. Profitable. The 3 years it lost money, it lost a lot less in percentage than it actually made during the years that was right. I like this. 2.3% average return on investment during the period between Memorial Day and July 4th. How about the 30 days after July 4th? Look like this. 80% win rate and a 3% ROI, and you can see the best year was 2022. The worst year was 2019. And the month leading up to Labor Day, well, it looks like this. 90%, 9 of the last 10 years winner, but a lot of those years were barely break even, just above break even, and one was a big loser, 2022. 2022 was a bear market year for much of the year. We all know that. I like the win rate. I don't like the return on investment. So when you add it all up, Memorial Day to July 4th, 70% win rate. ROI is nice. July 4th to August 4th, the best opportunity, 80% win rate and a 3% ROI. August 4th to Labor Day had the best win rate percentage, but the ROI was terrible as we started to break down in mid-August. So my plan looks like this. I want to combine the best of the best. I want to look for 80% and an ROI of 6%. And that means trading between now and about mid-August. And also, instead of buying the ETF, what about call options or even call spreads to help juice the returns? Well, today, I'm looking at a trade, the SPY, trading right below 600. The 600 call with an expiration of August was pricing in at $17.33. That means it's going to cost $1,733 to get into this trade. All right. Sounds a bit, it's cheap, cheaper than buying 100 shares of stock. But what has to happen for me to make money in this trade? Well, here's what has to happen. If we do the math, we know that buying the August 15th 600 calls is going to cost $17.33 as of the last print that I saw. That's roughly 3% of the S&P 500. But if we're looking for a 6% move over the summer, which is a 35-point move with today's SPY price, we're talking about $17.33 cost and a potential 100% return on this particular trade. Now, you might be saying to yourself, Tom, I love it. I love the research. I love everything I'm seeing here, but I still don't like the cost of that call option. That's $1,733. How do I make that lower and yet still have a chance for a double? That's where call spreads come in, folks, where you're buying a lower strike call and selling a higher strike call. So I would tell you, take a look at the call options that are at or above $600 on SPY. Take a look at the call options that are around the 630 to 635 area for SPY. You buy the lower, you sell the higher. You'll find many in between there. When you put them together, they're trading for $500 or less. All right. Now, if you want the full details of what I just talked about in the last few minutes, you can take a look at my 35-minute webinar on this entire thing, where I get into full details. The description is below. Thanks for joining me. I'll see you on the next one.